Welcome to Alpha Recap, your end-of-day market wrap from stockalpha.ai. I'm glad you're with us. As always, if you have questions, you can reach us at stockalpha.ai. Today we're breaking down two themes that dominated the tape into the long weekend. A debate about REIT ETF choices, RWR versus XLRE, and a stock-specific momentum move in Jabil. Markets were closed for the weekend, so everything we discuss reflects the close on Friday, June 12th.
Great to be here. The two themes were really different in nature, but connected in how investors think about allocation versus trading. One was structural, the RWR versus XLRE choice, and the other was idiosyncratic, Jabil's pop heading into the weekend.
Okay, let's unpack both. Start with the ETF debate. What were analysts saying about RWR versus XLRE?
Sure. Analysts framed the choice mostly as a trade-off between breadth and cost. RWR tracks a broader REIT universe, more specialty subsectors and smaller cap names. XLRE is restricted to S&P 500 constituents, so it's more concentrated in larger, more liquid real estate companies. That feeds into a classic diversification versus concentration decision.
So, what really stands out here is fees versus exposure, right?
Exactly. Fee drag came up a lot. XLRE typically has a lower expense ratio, so for long-term, passive allocations, those smaller fee differences can compound over time. But for someone trading tactically, tracking error and liquidity can matter more than a few basis points.
And how does volatility and income profile play into that?
Broader REIT coverage, like RWR, tends to change the yield profile. You might get higher income because niche REITs often pay more, but you also get higher idiosyncratic volatility. Smaller names and specialty sectors can swing more. S&P-focused exposure in XLRE often offered steadier distributions because the companies are bigger and more established.
Right.
Right. And the other thing is the attention dynamic. Analysts pointed out that ETF flows and Wall Street focus can create short-term divergences from fundamentals. So sometimes performance is flow-driven rather than coming from the REIT's underlying income streams.
Who does each ETF really suit?
It depends on constraints and goals. Income-focused investors who prioritize stable distributions might prefer the S&P real estate exposure because it's more concentrated in large-cap names with steadier cash flows. Core equity allocators, think pension funds or diversified funds, care about fees and liquidity, so XLRE often fits operational needs. Tactical traders or momentum players might favor the broader RWR if they want access to niches that can move fast, but that comes with more volatility. Active managers might like the broader index to find mispricings among smaller REITs.
So there really wasn't a single winner, more a set of trade-offs.
Yeah, absolutely. Analysts generally agreed there was no universal correct choice. It's all about the role real estate plays in your portfolio. Income sleeve versus beta-like equity exposure, fee sensitivity, liquidity needs?
Let's shift to Jabil. I know there was a discrete uptick. Give us the color on that.
Sure. And the number that really caught our eye? Jabil closed at $384.82 on Friday, June 12th, up about 2% from the prior session. Analysts tied the move to a mix of company-specific headlines, renewed analyst attention, and short-term momentum ahead of the weekend.
Hold on, say that again?
Yep, $384.82, up about 2%. The coverage framed it as a short-term bullish sign rather than a definitive structural shift. Momentum was running, but analysts emphasized watching upcoming catalysts to judge sustainability.
What should people be watching if they want to understand whether that move has legs?
Key data points included backlog levels, gross margin trends, and end market demand signals. Consumer electronics, industrial automation, and similar categories that feed into Jabil's revenue mix. Analysts also warned about risks like input cost swings, supply chain disruptions, and customer concentration. Those factors could easily reverse short-term gains if they re-emerged. Honestly, I was a bit surprised by the pop. It was modest, but it underlines how single stock momentum can happen independently of broader sector debates.
So we had a structural debate in REITs and a tactical move in a single stock. How should different types of investors think about both narratives?
Analysts broke it down by investor type. For income-focused folks, the main lens is distribution stability. RWR's broader universe might offer higher yields, but more volatility, while XLRE tends to be steadier. For core equity allocators, fee drag and liquidity matter. Lower expense ratios and big, liquid constituents make implementation cheaper and easier. Tactical traders need to watch flows, daily liquidity, and catalyst calendars. Active managers might favor the broader index if they want security selection opportunities among smaller REITs.
Got it. Any practical watch list items, things people can actually track?
Absolutely. Analysts suggested a few decision inputs. Track interest rate moves and cap rate trends since those reprice REITs across the board. Monitor ETF flows and bid-ask spreads for implementation costs. Examine index composition and top holdings if you're worried about concentration risk. And for companies like Jabil, follow backlog, revenue by end market, margin progression, and guidance updates. Rebalance with intent. Don't let trailing performance alone drive which ETF you pick.
Short reactions.
Yeah, that tracks.
Right.
Mm-hmm.
Before we close, give us 3 clear takeaways from today's coverage.
1. The RWR versus XLRE choice is a trade-off. Breadth and potentially higher yield versus concentration, lower fees, and liquidity. 2. Short-term price moves, like Jabil's roughly 2% uptick to $384.82, can be momentum-driven and deserve monitoring of near-term catalysts before assuming permanence. 3. Macro variables. Interest rates, cap rate shifts, and growth still drive REIT valuations, so keep those as your North Star when you're making allocation decisions.
Quick reminder, this conversation is for informational purposes only and not investment advice. We didn't tell anyone to buy, sell, or hold anything. Analysts note and data suggest. That's what we discussed.
Right. Analysts' views were presented as context for decision-making, not as recommendations. Always align allocation choices with constraints, objectives, and time horizon.
Great. That wraps up today's Alpha Recap. If you have questions about anything we covered today, head to stockalpha.ai where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening and enjoy the long weekend.